Hey, it's Soleil, and this is episode 151 of the Orange Pill Investor. And I was shown on my page this post from Cole. It's either Cole Grinde or Grinde. I'm not really sure how to pronounce it. But he basically was saying what I've been saying and talking about getting like 1.5% a week selling options. And the thing went crazy. People are calling him a liar and all kind of stuff. So I mean, we don't even like follow each other, but we have a bunch of mutuals, so that's why it was on my page. And I had to go in and reply to some of these people. I went a little Pulp Fiction, Ezekiel 25:17. The path of the righteous man is beset on all sides by the iniquities of the selfish and the tyranny of evil men. Blessed is he who in the name of charity and goodwill shepherds the weak through the valley of darkness, for he is truly his brother's keeper and the finder of lost children. And I will strike down upon thee with great vengeance and furious anger those who attempt to poison and destroy my brothers. And you will know my name is the Lord when I lay my vengeance upon thee. And that's when I came in guns blazing. Now, it really wasn't that serious, but any excuse I can quote Pulp Fiction is a good reason. So I'll post a link to it in the comments, but to me this is just like easy, and he's not even exaggerating. So I figure I'll just go over the strategy and show how easy this is. Now, granted, some people may say the mining stocks are a little too risky or whatever. I mean, people want to own the SPY, and that's fine. But this is after hours, so this won't be exact. But I mean, if I don't care about getting assigned, I can just sell at the money for Mara and get 5%. Like this is, and that's one of the comments. I'm like, people are saying, "Oh, you're a clown." They're calling him a clown. Tony's lying. And I'm like, dude, you can just go to the options chain, and these are the premiums. Like, go here, click the button, click continue, get paid $100, and you'll see your account value go up. Your buying power will go up by $100. Your account value doesn't actually go up by $100 because in order to close this contract, it's still worth $1.10, so you'd have to buy it back for $1.10, and you'd have the same amount of money you started with. You'd be actually down a couple bucks because the bid-ask spread, it's going to cost you $1 or $2 to fill it and another $1 or $2 to close it. So if you sold this and immediately bought it back, I mean, you'd lose a couple of bucks. There's a little bit of friction in every trade. But, yeah, I mean, you could just go in here and look at the frickin' options chain. I mean, to get 10% in Mara, some people were like, oh, 1% is too risky. I only can get 0.5%. I'm like, okay, if that's your risk tolerance, then you go for that. But I mean, I can sell the 17 strike here and get 1%. That's the price of Mara can drop 10%, which is $1.90. Can drop $1.95. Well, let's just say $2 because it makes the math easier. But that's the 17.50. If it drops 10%, it's still above the strikes, and you'll still be able to sell it for almost, all profit on Friday. It would have to fall like 15% or something stupid, which it can do, and it has done it to me. Like, I'm not going to say it hasn't, but I'm a Bitcoiner. Like, this shit is normal. I mean, like, okay. This is what I think traditional finance investors don't understand, because they only have to deal with like the stock market crash of 87 every 20 years, 30 years, 40 years, 50 years. What happened in 2020 only happens, every a couple of decades or whatever. But this is a Bitcoiner's life right here. This chart, you get 11 Bitcoin's going from 10 to 50, and in this cycle, everybody was talking about 100K. Bitcoin's going to 100K, 100K, 100K. So Motherfuckers get FOMO right about here, you know, 38, okay, this little dip right here, and then it starts to pump, and people are like, oh my god, it's going to go to 100, and they start freaking FOMOing, and they start buying the top, and then they shit themselves when it drops to 31, and then if they haven't already panic sold, now they're just gun shy, and they're happy. Like if they, I bet you, the people who bought into Bitcoin for the first time at 59, they sold this shit at 59 right here. They were just like, I'm breaking even, I'm out, I'm done. And technically that was actually kind of the right call because it only went to 60, I think it went to 67. And then it, you know, and then that was the end of the bull market. But that person probably never bought Bitcoin again. They just swore off crypto and tucked their tail between their legs and never came back. But this wasn't my first cycle. So, I mean, I was buying Bitcoin, and when it went to 17 the first time, this doesn't go back long enough. Screw this chart. But, you know, I had Bitcoin when it was 17. Bitcoin USD. Oh God, waiting for data. This is going to piss me off. All right. I might have to just exit out and sign back in. Doesn't even matter. The point is, when it was 17 and crashed back down to 5 or whatever the hell it was, and when it was 65 and it crashed back down to last year, what was it, 15 at its lowest? I think it was around 15. That just, you just become numb to that. So when people complain to me and they're like, oh, but you're going to lose money in a bear market, I'm like, yeah. Everybody who's not short is going to lose money in a bear market. Like, what are we even talking about? And if you're in the stock market and you don't know that it can go down sometimes, what are you even doing? But that's your problem. Like, I'm fine with that risk. If you're not, then go hedge it. I don't know. How do people hedge? They buy puts or whatever. Go buy puts. I don't know what to tell you. So for a frickin' diamond's hand calloused Bitcoiner, if your stack goes down 75%, like that's just how it is. That just doesn't bother me. And if you're 65 and this is all you have to retire on, and you can't risk this, then that's fine. Then do something else. But when I bought my Mara, Bitcoin is at all-time high. So I think I was buying Mara. What was my average cost? 20. So my average cost, I was buying like around here. And then, of course, Bitcoin retraced back down to 60 or whatever the hell it was. And my Mara dropped 30%. It doesn't matter. I know some of the commenters were like, oh, but then you get stuck bag holding and you can't get as much premium. I'm like, well, no shit. If your account drops by 30% and the strategy is getting 1% of your portfolio, well, your portfolio is less, so you're going to get less. I don't understand why that's they think that that's like a checkmate response. So, when the price of Mara was down here at 15, then I was selling the 1650 or the 17 strikes. And then maybe it went to 19. Well, I recovered my value from 15 to 17 and a half, and I missed out on the upside to 20. So then I sold the 21, and it didn't go over 21, and I kept all of it. And then I sold the 21 again, and it went to 16, and I kept all of it. And then I probably sold the 17 and a half again, and maybe I missed out on some upside to 20. It doesn't matter. Then I sold it again, and it didn't go above it, and I kept it all. And then I sold it again, and I kept all of this. And I sold it again, and maybe I lost a little bit on this one, because if I sold the 1950 and it went to 2020, it just doesn't matter to me. Now, there's some people that had some tax considerations, and that's all valid, criticisms, concerns, whatever. But I'll link this conversation in the comments. But they were trying to drag this guy, and as soon as I saw his post, I'm like, oh yeah, that's what I do. It's automatic. It's not even hard. And one of the accounts we follow each other, 10x investor, and he's like, yeah, it only takes like an hour a day. And like these returns that Cole is talking about are actually very conservative. I mean, I can get way more if I want to get assigned more often, if I want to take more risk. And if I don't mind if my shares get called away, I could sell them even more aggressively. So these shares of Mara at 1950, I would probably pick the 2150 strikes. The price was higher when I set these, so it was 21, so I picked a 23. But if I don't mind these shares getting called away, I can sell the 20s for 73. That's 3% for the week. It's only like 50 cents worth of call away value built into that. But the strategy is completely customizable based on how much premium you want to collect, how much call away value you want to build in, or if you're selling the puts. I usually just sell at the money. I just if I sell the 19.5, I knock the cost basis down to 1840 right off the bat. So technically, I don't even lose money unless the price of Mara goes below 1850. And it could. I just showed the chart. It's dropped that much a bunch of times. 22 down to 15, 19 down to 16, 20 down to 17, 22 down to 19. I'm not really a TA guy, but I will just point out that there's higher highs and higher lows here. We'll zoom out a little bit more. Yep, higher highs and higher lows. This is coming back down a little bit. If I just zoom in, like, oh, okay, maybe this is trending back down again. But yeah, don't come for my boys, my option sellers, or we'll come for you. All right, so high five to Cole. He's basically sounds like he's doing exactly what I do. From the returns that he's getting, it looks like he's got his account is bigger than mine, and it sounds like his portfolio is bigger too. But exact same process. He has a more diversified portfolio. Somebody asked him what stocks he uses, and he listed like 10. The only mutual that I think we had was Tesla and CLSK, which I don't actually trade CLSK, but it's a mining stock, so I trade the others. Mara, Hut, and RIOT are the ones that I have. But yeah, so I assume this is what he's talking about, just selling cash secured puts. He was talking about getting 1.5%. So 1.5% of 1950 would be $30. Sell the 17.5, boom. Get paid $30. Collateral is $1,750. 1% of that would be 17. Oh, I'm sorry. Yeah, so I said 1% and a half of this would be what, 30. But it's actually 1.5%. I need to figure 1.5% for the strike that I'm selling. So that would be, I would need to get 27 here. Holy crap, I think you can go all the way down to the, yeah, 17.5. 1.5% of 1750 is about 18 plus 9, 27. Yeah. So right here. And if you end up getting assigned shares, you're getting the discount. You're getting a $2 discount off the current share price anyway. So that's already you're already just buying the dip, and you got paid an extra $30 on top of it. So really, you're buying these for $17.20 if you get assigned. Now, if the price, that doesn't make you feel all that much better if the price goes down to 15. But if you set a limit purchase order for $17.50 to begin with, and that got filled and it went to 15, you're still in the same boat, except you didn't get paid the $30. So the way I figure it, you might as well get to pay the $30. All right, so it's just that easy. Step 1, sell a cash secured put, click a strike below the current share price, collect the monies, wait till next week. And I don't even know if he does weeklies or 45 days of expiration or 2 weeks expiration, whatever. But let's actually just check that out. So let's go out. Let's go 47 days. Uh, 98. Yeah, let's go down to like the 16. Oh no, wait, there's no liquidity at 16. 15. Sometimes whole like round numbers. There's no volume and interest here. I don't like the looks of that. The bid-ask spread is like sucks. So maybe I'm not even gonna bother with this example. So the point is, I don't know what he's doing. Maybe he's going out 1 or 2 weeks. Some people prefer to just go out 3 to 4 weeks. Anything under 45 days, I think, is viable. Doesn't even really matter. But you sell the put. If you get assigned, then you just flip this to sell the calls, and you decide how much. Again, if you want to get paid the $30, you pick the 22 strike. You got all the upside built in. You can profit from 1950 up to 22. That's what this little chart means. You're green up until the price of Mara exceeds 22. And then at that point, you know, Robinhood scares some people because if you scroll all the way over here, it says, oh, unlimited losses. But your shares are just going to get called away. It's a defined risk trade. So don't let the unlimited losses scare you on a covered call trade. And one guy actually suggested, sell credit spreads, and that is supposed to be a defined risk trade as well, but there are some assignment risks. If someone exercises on you, and then you exercise to prevent unlimited risk, and then they cancel their assignment, and you don't, you can get wrecked. So I don't really mess with the credit spreads too much. I did set up a couple recently for fun. But the reason why I prefer to sell cash secured puts and covered calls is because worst case scenario, I own 100 shares of something, and that has, as long as it doesn't go to zero, it's worth something. And if it's worth something, I can sell a covered call against it. So I like owning something of value. You know, other people think, okay, well, I think Mara next week will be really worth $22 a share, and they're willing to gamble and pay me $30 for the privilege of rolling those dice, and I'm more than happy to accept their kind donations. All right, I'm gonna leave it there. You mess with my option seller brothers, you mess with me. Same goes for Bitcoiners. All for one, one for all. And I'll leave it there. Be good, Joe.